The likelihood of the kind of price crash we saw back in 2008 is extraordinarily slim. Those people aren't going to be motivated to sell their house anytime soon unless they absolutely have to.
Though it's his first time here on GRE, you might have already heard of today's expert guest because he's been the Executive VP of Markets at some of the leading housing intelligence firms like Adam Data and Realty Track. He was twice named to the Inman News Inman 100. That's an annual list of the most influential real estate leaders. He's one of the country's most frequently quoted sources on real estate, mortgage, and foreclosure trends. You might have seen him on your television seemingly everywhere. CNBC, CBS News, NBC News, CNN, ABC News, Fox, Bloomberg, and NPR. That's a lot of the letters of the alphabet right there. Today, he is the founder and CEO of CJ Patrick Company. They're a market intelligence and advisory firm for the real estate and mortgage industries. He has over 20 years of experience in those industries. Hey, welcome here for your GRE debut, Rick Sharga.
I am happy and honored to be with you today.
Rick, home sales have plummeted. You've got what I'll call these YouTube crash bros that publish these videos that seem to forecast a housing price crash. I actually don't see how that can happen. Maybe they're headlining things that way just to get clicks. I don't know. I plan to get into that with you and quite a bit more.
Yeah, you and I are on the same page there. I think anybody who's selling you on a price crash in the housing market is actually trying to sell you something else, and very likely something you don't want to buy. There's a whole host of different motivations when it comes to what you see on YouTube these days. But as we'll talk about as we get into this a little further, the likelihood of the kind of price crash we saw back in 2008 is extraordinarily slim.
Yeah, I don't see how that can happen, headlined by the still relative dearth of supply that we have today. And really that low supply is one reason that home sales have plummeted. There's just not enough available for some people. There sure are some other reasons. You know, Rick, what I've shared with my audience the past year or two, I have told my audience that the housing crash already happened. There's a 100% probability of it occurring in this era because it already happened. And a lot of times that gives people pause. And I say, we're not talking about a housing price crash. We're talking about a housing supply crash, which occurred around April of 2020, about 3 years ago, when the supply of available homes failed to make its seasonal rebound. The crash already occurred, a supply crash, not a price crash. And in fact, this supply crash is what hedges against a price crash.
Yeah, you're right. And the fact of the matter is that about 70% of homeowners with a mortgage have a mortgage with an interest rate of 4% or lower.
Yeah.
Those people aren't going to be motivated to sell their house anytime soon unless they absolutely have to. You're not going to trade in a 3% mortgage for a 7% mortgage on a more expensive house. So that's one of the main factors that's going to keep supply low. And to your point, as long as supply is constrained, you're not going to see a huge fall off in pricing. In fact, most of the realtors I talk to across the country are telling me they're still getting multiple offers on properties that are priced accurately for today's market. Now, they're only getting 2 or 3, not 20 or 30 like they were a year and a half ago.
Right.
But people are still looking to buy homes. And one of the things we'll probably talk about a little bit further is that there is a tailwind in the housing market because we have the largest group of young adults between the ages of 25 and 34 in U.S. history. And those are prime ages for forming households and for buying a house. So that wave won't peak until sometime in 2024. And as long as we have people looking to buy properties, looking for somewhere to live, you're going to have that demand that keeps prices from plummeting.
Interest rate lock-in effect. All these homeowners have these ultra cheap mortgages. It's very difficult for them to want to give up a 3 or 4% mortgage to go live in a home with a 7% loan today. That interest rate lock-in effect, which means those homes don't come on the market, further constraining supply.
Yeah, economists refer to that as rate lock, and it works exactly the way you just suggested. And one of the things that your listeners should probably keep in mind is that these mortgage rates are now up almost back to 7% on a 30-year fixed rate loan. Interestingly, I saw today that the the yields on the 10-year U.S. Treasury are back above 4%. And that usually means you're going to be looking at mortgage rates 2 to 3 points higher than that. So not a surprise to see what we're seeing. But last year, 2022, was the first year in U.S. history that mortgage rates actually doubled within a calendar year. Doubled. And in fact, they didn't double in a calendar year. They doubled really in the course of a few months. So what normally happens in a market, as you know, is interest rates might go up a little bit, prices might go up a little bit, and buyers adjust. They were looking at a $400,000 house. Now they're looking at a $350,000 house. But when your mortgage rates double, that means you can't adjust from 400 to 350. You have to start looking at a $200,000 house. And it was too much sticker shock, too much of an abrupt adjustment for the market to really adjust to in that short a period of time. And that's one of the reasons that we've seen demand drop off pretty significantly. And in fact, according to the Mortgage Bankers Association, purchase loans, the loans that people apply for to buy a house, are off 44% from last year. Lowest levels we've seen of loan activity in 3 decades. So the demand, even with what I said a few minutes ago about demand still coming from those young adults, overall loan application activity is way down, and that's why we're seeing fewer homes sold. That's a pretty good predictor of future purchase activity.
Purchase loan applications down 44% over last year. And this is emblematic of this low affordability brought on by higher mortgage rates. So when I talked earlier about how supply has plummeted or about how sales have plummeted, understand that we're talking about sales volume here for you, the listener and viewer. We're not talking about prices. We'll get to prices and what we think the direction of prices are going to do.
Yeah, and a great segue, because one of the things that we share with everybody we talk to is sort of the results of existing home sales and new home sales, and we'll break them out into two different areas. But existing home sales last year were down 18% from 2021. Now, a couple things to keep in mind there. One is that 2021 happened to be a relatively strong year for existing home sales. So we ended the year with roughly 6.1 million existing homes sold in 2021. That dropped down to around 5 million last year. So it was a pretty significant drop off on a year-over-year basis.
And Rick, you just gave us a great piece of context, because when we apply the year-end 2022 data and numbers, we got to be mindful that we're comparing those to 2021. Right. 2021 was such an atypical time in the housing market. Sales surged. Prices surged. Mortgage rates were artificially low, almost fake. They were so low, yet they were real enough for you if you happen to get one of them. So when we talk about a slowdown, we need to understand that we're coming from a rather high place as far as sales health goes.
Yeah, and for the people joining us and who are seeing the slides, they're seeing something that I've never seen before in the market, which is the strongest month of home sales in 2022 was January, and every month after that, we sold fewer homes than we'd sold the month before.
That's rare.
So normally you get a spike in the spring, you get a spike in the summer. Yeah, those are the prime times for buying properties. That didn't happen last year, and in fact, January existing home sales were lower this year than December of 2022. So we've continued the trend into January of this year. So not getting better faster. But you made an interesting point earlier that one of the other things besides affordability that's keeping home sales low is lack of inventory. And I'm showing a chart right now that shows two really important ideas. One is what you just said. In a normal market, we have about a 6-month supply of homes available for sale. Today, we have about a 2.5-month supply across the country. And in some states, it's even less than that. So there's very, very little available for sale, about half of the inventory we'd usually want to see. One of the other things to keep in mind is that right before prices crashed during the Great Recession, we had about a 13-month supply of homes available for sale.
Yeah.
So twice as much as the market can usually eat. And that peak came right before we had about 15 million adjustable rate loans that never should have been made. They were horribly underwritten loans to borrowers who really weren't qualified. they were all coming due at precisely that time. So we had millions of these loans being reset, which meant properties coming to market because the borrowers had to sell. They were selling into an oversaturated, oversupplied market. A lot of them went into foreclosure, which drove prices down even further. So it was sort of a perfect storm of bad things happening. The market dynamics this time could not possibly be any more different than they were then. And so, oversupply versus undersupply, bad loans being reset versus about a tenth of those adjustable rate loans being in place today, and those being very well underwritten. So, and we'll talk about it later, but virtually nothing in foreclosure. So, again, market conditions this time couldn't be any more different if we tried to sketch them out that way.
Yeah, that'll be important to look at that foreclosure data later, because that's really a distress signal of the health of the American homeowner. But you've got more on new home sales. We're talking about brand new homes versus existing ones here. Yeah,
so new homes, the ones the builders are bringing to market, they were off by about 16% year over year, a little more variability in the month-to-month numbers. And you'll see that in new home sales for a variety of reasons. But unlike you or me or somebody else who might be sitting on a really attractive mortgage rate who's not inclined to sell, if you're a new home builder, if you're Pulte Homes or Toll Brothers or D.R. Horton or even a local builder, and you have 3, 4, 5, 6 homes sitting there vacant at the end of a development, they're costing you money every month. So you're going to be motivated to move those homes.
And a lot of those developers have shorter term debt that's at a higher interest rate. So they are motivated to move them.
They really are. And you're right that the financing charges, particularly for small builders, is much higher. So you're going to see those builders offer concessions, pay down points on a mortgage, maybe even do price reductions in order to move those properties. And there's also a little bit more rate sensitivity from buyers. So one of the things we did see is in some short periods of time in 2022 where interest rates were coming down a little bit, you saw a bit of a surge in new home purchase activity because those properties were already on the market and people could act quickly to try and move into them.
Rick, we work with a lot of new builders and help connect our audience with them. You might find it interesting that one of our providers in Jacksonville, Florida, is offering $10,000 of buyer incentives. They typically sell homes that sell for about $275K. The $10,000 comes from $5,500 in buyer incentives to help you with your closing costs, especially in buying down your mortgage rate. Another $1,500 comes from them waiving their leasing fee. And then they're paying another $3,000 toward maintenance during your ownership of that rental property over time. $10,000. That's 1% of a million that this particular new builder is offering. So we're seeing that with a number of new builders that we work with here, Rick.
That's a great point, and it's very unusual for an investor's best prospect to be a builder. Usually those are more expensive properties, and very often those builders aren't really likely to negotiate the way you're talking about now. But market conditions change, and if you're an investor looking for inventory, the builder market is a little bit more oriented toward doing deals than they normally are.
Yeah, it sure is. So when we talk about those new builders, oftentimes they have higher mortgage rates. We just have to think about how different that is, again, with those existing homeowners that have the low mortgage rates. So therefore, I see maybe a greater proportion of new builds coming onto the market than renovated versus what that ratio is like historically.
Yeah, and I'd caution about saying more when it comes to new construction. I understand what you're saying. I'm mostly joking there, but we're not going to be building our way out of the property.
Still not that much overall, right?
Yeah. So we a couple things to point out. About midway through last year, it was in July, we saw new housing starts drop by 18% year over year. And for the rest of the year, every month we were off by double digits from the year before. So during the last cycle, the builders kept building even when buyers stopped buying. This time they got the memo. So when they saw buyer activity slowing down, they dramatically threw the brakes onto housing starts. So we have this really weird phenomenon going on right now where the number of completed homes available for sale is almost as low as it's ever been since this data began being recorded in 1973. On the other hand, we have a record number of properties under construction that will gradually come to market over the course of the year. And they've built up like that because of supply chain disruption. So the unavailability of materials and supplies because of labor shortages and because of some other odds and ends. But we're not seeing a lot of new building. We're not seeing a lot of permits being issued when the balance of these properties that are under construction eventually comes to market. You'll see the supply kind of dry up after that in terms of new housing development.
Maybe it's an interesting time to ask. Everyone reads about the housing shortage they have for years. I've seen estimates as to the number of units short in America range from about 1.5 million to 5.5 million. Very few people seem to agree on the number, but nearly everyone agrees that we have a housing shortage. This could be very difficult for you to answer. It's a little bit of a crystal ball here, but maybe if you can just talk to us about a range. When do you think America is finally going to have an adequate supply of housing? I mean, we're talking years here.
Yes, it's a best case scenario. It's probably a 5 to 10 year window.
Yeah.
And for a little while in 2022, the first half of the year, it looked like the builders were getting serious. We were looking at housing start numbers every month on an annualized basis of 1.2 to 1.5 million homes. And that would have made up that shortage relatively quickly, maybe more like 4 or 5 years. But since they've scaled back, and again, we have this tailwind of demand coming to market, it's going to be a while before we catch up. And that you mentioned earlier, and we were talking about the lack of a likelihood of prices crashing. We've seen price appreciation decline pretty rapidly, but interestingly, if you look at the end of the year of 2022, prices still went up about 6% year over year. So even with home price appreciation declining from, it had been 15 to 20% on a year over year basis, depending on where you were in the country. It was about 8% in the fourth quarter, and by the end of the year, it was still at about 6%. Now there are some markets, places like California, where we're actually seeing price declines year over year, and I suspect by the time we get to the end of this year, nationally, home prices will probably decline, but somewhere in the neighborhood of 5%. But it's not going to be a one-size-fits-all correction. And I'm showing a national chart from Freddie Mac that shows that the West Coast is where we're seeing prices decline most rapidly. California, Arizona, the Pacific Northwest, and some of the so-called Zoom towns, places in Colorado and Utah and Idaho, and even Nevada, where we saw a lot of growth during the early stages of the pandemic. Those are markets where we're seeing prices decline. But if you're looking at the Southeast, the South, the Carolinas, Georgia, Alabama, Florida, we're actually seeing prices go up. So it's really important for an investor to be a local market expert when it comes to pricing and understand that what they're seeing in the national media may not be really reflective of what's going on in their market. There really isn't a national housing market. There are thousands of local housing markets across the country, and what's happening in San Francisco, California, is not at all the same thing that's happening in Raleigh, North Carolina.
This is such a broad generalization. There are so many exceptions to this, but in general, the western half of the United States have actually seen price declines, and the eastern half of the United States have seen mild rent increases here in the recent past. Now, there are a few exceptions, maybe in the major metro areas of the Northeast, but generally that's it. East, stable or up, west, down.
And then again, we've talked about this. I did have a chart that I'm now referencing, but if you look at demographics, we're not talking about a housing market that's propped up by speculative buying, by high risk buying activity. It's driven by demographics. We have, again, the largest group of 25 to 34-year-olds in U.S. history, and they are forming households at much higher rates than they were just 5 years ago. So it's a demographically driven demand wave that once we address some of the affordability issues will be coming out, I believe, in force once again. Typically, in a normal market, about 4% of loans are delinquent, and another 1% are in foreclosure. And the difference really is twofold. One, it's a matter of the length of the delinquency, and the other is that there's a point where a lender, a mortgage servicer, will actually issue a formal document that's called a notice of default, or in some states it's called a lis pendens filing through the courts, that notifies the borrower they are technically in default on their mortgage contract. That starts the foreclosure process. And the foreclosure process in most states is a three-stage process. You have your initial notice of default. If you don't cure the default within a certain period of time, you get a notice of sale, which is a warning that your property is going to be auctioned off either at a courthouse auction or in a sheriff's sale. And then that sheriff's sale or courthouse auction takes place, and the property is either sold to a third party, an investor typically, or it's repossessed by the lender. Delinquencies are kind of that canary in the coal mine, if you will. They kind of are a warning that something bad is likely to happen. And recently, we've gone through a little bit of a roller coaster with delinquencies. When the pandemic hit, we saw a huge spike in serious delinquencies. And serious delinquencies are what the industry refers to as loans that are 90 days or more past due. And there were a lot of people saying this was a predictor of a coming wave of foreclosures. And I was telling people that wasn't the case, and people were looking at me like I was crazy. But the reason serious delinquencies spiked the way they did is because of the government's mortgage forbearance program,
right,
which was part of the CARES Act. So all of a sudden, you had 8.5 million people going through this forbearance program. And as soon as they missed their third month of mortgage payments, they got lumped into this serious delinquency bucket, even though they weren't required to make those mortgage payments because they were in forbearance. So really what we saw was an artificial spike in serious delinquencies. And as people have exited that, I think we had 8.5 million people go through the program. At its peak, there were about 4.4 million people actively in forbearance. Now we're down to about 325,000. And the number of seriously delinquent loans has really come down significantly. We're at 3.96% overall in terms of delinquencies. That number is a little higher than it would be because we've had some natural disasters where people are behind on their mortgage payments, but typically working with their lenders through that period of time. But yeah, so delinquency rates are back to where they've been historically and where they were prior to the pandemic, at just below 4%. So you're probably reading or seeing something about delinquency rates going up, but they're only going back up to kind of normal levels, not crisis levels. This might be an area of vulnerability in the housing market, might be something your investor listeners will want to pay a little bit of attention to. If you look at what's driven the increase recently in delinquencies, it's early stage delinquencies. So it's people who have missed their first month of mortgage payments. And we've seen a pretty significant spike in terms of FHA loans going delinquent. So if you look at conventional loans, 30-year fixed rate loans that Fannie and Freddie typically underwrite, if you look at even loans through the Veterans Administration, VA loans, they're all down below 2% early stage delinquencies, where FHA loans are up to about 5%. Now, again, if you look at FHA loans historically, they're typically somewhere between 4.5% and 5.5%. So they're not out of normal levels. But it's a pretty significant, pretty quick spike. And my concern with the FHA loan portfolio is that most of these borrowers have limited equity because they've taken out an FHA loan with a 3.5% down payment. They typically have lower cash reserves. They typically have higher debt to income ratios. And they typically are at either the median level or lower levels in terms of household income. And those are the households who are struggling the most in our current high inflation economy. They spend a lot more of their take-home pay every month on necessities like food and heating bills and gas. We've seen how this movie ends before, and at some point, these households have to make a decision between heating their home and buying food or paying their mortgage. Yeah. And the movie tends not to end fairly well. So if you're in a market that happens to have a lot of FHA loans, you might want to be on the lookout for some early stage delinquencies in those markets. What happens a couple of months after that, Keith, is you get something called a foreclosure start. So it's that first foreclosure notice. Typically, it doesn't happen until somebody's missed 3 consecutive monthly payments. In some states, it's actually 4 monthly payments. And that starts the foreclosure clock ticking. And this is where, if I were an investor in today's market, I would be looking for opportunities. And I'll share why this is an opportunity as we get into it a little bit further. But in prior cycles, typically lenders would wind up repossessing a very high percentage of properties that entered foreclosure. The borrower wasn't able to sell the property effectively on the market before the auction. A lot of properties weren't purchased at the auctions, and so lenders repossessed a lot of these properties. And if you're an investor, you waited for the lender to take the property back, eventually bring it back to market and try and buy it as what the industry calls an REO, or a real estate owned asset. So foreclosure start activity now is back to about 80%, give or take, of where we were back in 2019 prior to the pandemic. So we're starting to see a return to that level of activity.
Now, as we look at these charts, I think 2019 is a pretty important year. A lot of people that look at statistics like this end up using 2019 as a baseline because, in a sense, that was our last normal year, if you will.
And I'm glad you brought that up, because even though it was our last non-pandemic influenced year, 2019 was actually relatively low in terms of foreclosures, historically speaking. So I mentioned earlier, in a normal market, about 1% of loans are in foreclosure. In 2019, it was about 0.6%. So the loan quality since the end of the Great Recession has been extraordinarily high.
Yeah.
And so we weren't seeing a lot of foreclosures. But now we're looking at foreclosure starts being at 80% of 2019 levels. So again, it's coming off a relatively low year. And this is the important thing I wanted to point out, is that when you look at repossessions by the lenders, they're running at about 30% of 2019 levels. So we know what's happening in this cycle is that more distressed borrowers are able to sell their homes prior to the foreclosure auction. So fewer properties are going to auction, and we have a much higher sell-through rate at the auctions than what we had in years past. So it used to be about 30 to 35% of properties at auction would sell. Today, it's more like 60 to 70%. So the people that are waiting for the banks to get these properties back so they can buy them that way are going to find much, much less inventory. And overall, then, foreclosure, and here's the important chart. The reason for all of this is that 92% of borrowers in foreclosure actually have positive equity in their homes. So if you go back to the Great Recession, one of the real problems we had is that home prices fell. About a third of all homeowners were in negative equity, which meant they owed more on their mortgage than their home was worth. And just about everybody in foreclosure was upside down on their loans. In today's market, 92% of the borrowers who are currently in foreclosure actually have positive equity in their homes. And they have a lot of positive equity. There's roughly 250, 270,000 people in foreclosure. Almost 100,000 of them have between 20 and 50% equity, which gives them plenty of money to sell their home, pay off their debt, and walk away with a pretty healthy check. Another 60 some thousand have between 50 and 75% equity in their homes. And about 35,000 actually have more than 75% equity. There is no reason on God's green earth why these people should ever lose their home to a foreclosure when they have the opportunity to sell it. As you mentioned earlier, Keith, there's such limited inventory out there. If they were to put these properties out on the market at full market value or even a little bit lower, they'd probably be able to sell them and avoid losing all their equity to a foreclosure sale. And for investors, the opportunity here is to reach out to these people in the early stage of foreclosure and work out a win-win deal. Work out a deal where you're able to buy property probably for a little bit below full market value, but also enable this distressed borrower to not lose all of their equity to a foreclosure auction. So you're really doing well while you're doing good. And it's a very unusual set of circumstances in today's market.
So the proportion of Americans that are in foreclosure is not historically high.
Nope.
Among the group that is in foreclosure, 92% of them have positive equity. And this is really important to avoid a 2008 type of situation, because there isn't going to be a fire sale of a home that's going to degrade and create this down drain of values in neighborhoods when even those in foreclosure have positive equity.
Great point. I think you hit that exactly right. And again, I think it's an opportunity for investors. So if you're there are places, and Keith, I'm sure you've talked about this, where people can find pre-foreclosure lists. They can find lists of people that are in those early stages of foreclosures. This is a great time to outreach directly to those distressed borrowers. A lot of them probably don't realize how much equity they have, and a lot of them probably don't know that they have the option of selling their house once they get that first foreclosure document. They might think that foreclosure document. They might think it's game over at that point and just kind of give up rather than look at other options. So you really can help somebody out of a jam, and in many cases might even be able to purchase the property and turn that borrower into a tenant if you're inclined toward renting a property.
And I know you have some thoughts on the overall economy as well, including recession prospects. We know that, well, I guess now the former definition of a recession is 2 consecutive quarters of contracting GDP. And you laugh, and I know why you're laughing, because sometime last year or so, that definition seemed to have changed and gotten somewhat fuzzy. And, you know, Rick, I think really the way I would classify the condition of the overall economy is there are more economic ambiguities than there usually are. You see layoffs, you see a lot of hiring too, you see more open job positions than you even have humans to fill them, for example.
We didn't really have time to get into a deep dive on the economy today. I just did a presentation to a group yesterday where I was talking about that in more detail. And you're absolutely right. Unemployment is the lowest it's been since 1969. We have 1.5 jobs available for everybody who's looking for work. Wages are going up at 4 or 5% on an annual basis. Our last jobs report was off the charts. We had 530,000 jobs filled. I will not say jobs created, because a lot of those are jobs that have been vacant since the pandemic.
Bounce back, yeah.
But still 530,000 jobs at a time when the experts, quote unquote, were expecting about 150,000. And so a lot of the economic indicators are really still very strong. The only really negative part of the economy right now is inflation and what the Federal Reserve is doing to combat it. And because of what the Fed is doing, because of how dramatically and how drastically and quickly they've raised the Fed funds rate in order to try and get inflation under control by weakening demand and slowing down the sale of goods and services so that the providers lower prices, which in turn lowers inflation, in case anybody's wondering how all this ties together. We are likely to see a recession. The last 11 times the Federal Reserve has raised the Fed funds rate in order to get inflation under control, 8 of those times, 8 of those times they waited too long or waited for inflation that got too high, and they steered us directly into a recession. They've already admitted this time that they waited too long, that they underestimated how severe inflation was going to be or how difficult it was going to be to get it under control. When the chairman of the Federal Reserve says something like, we're going to get inflation under control, even if it causes a recession, you know that's pretty much what they're expecting to happen. So they might pull off a miracle and execute a soft landing, which, you know, would be kind of no growth, but no recession. But I think the overwhelming likelihood is we do see a recession. But the good news, Keith, is that because all the other aspects of the economy continue to be strong, if we do have a recession, it's likely to be fairly short and fairly mild. And unemployment probably won't get much higher than 5.5%. And historically speaking, we're a little bit spoiled because we've had such low unemployment for so long. But historically, if you're at 5% unemployment, it's almost full employment. So hopefully that's what we wind up with. If we have a recession, it won't be a terribly egregious one.
Okay, so we're talking about Rick's outlook for 2023. He already talked to us about recessions. I've been quick to remind people that a recession isn't the end of the world. It's just part of the normal business cycle. On average, they occur every 5 years. So as we continue to look at your outlook, you've got 6 or 7 items on your outlook. You discussed recessions. How about mortgage rates?
Yeah, I believe, I'm hopeful that mortgage rates have already peaked for this cycle. Now, the churn in the markets over the last week has caused bond yields to go up, which has led to mortgage rates going up a little bit. But I still believe that by the end of this year, we will see mortgage rates gradually decline back into the fives, which coupled with wage growth should help to improve affordability for people looking to buy homes. The other thing that'll help affordability is we are likely to see home prices decline a little bit nationally. We talked about this earlier, but I'm not looking for huge drops. You might have a 10% decline in a market like coastal California. Some other markets might be up 2 or 3%, but nationally, I think you're looking at prices either plateauing or coming down slightly. And I think that'll also help improve affordability for buyers.
Yeah, it's interesting. In some areas, if home prices were up 40 to 50% in the last 3 years, and then in California, if they step back 10%, that's really not so bad overall. And I think you would probably agree or tell me that you expect to see more price stability in the Midwest and South.
Yeah, I think that's a good way to characterize it. Midwest, Southeast in particular. And the markets that do have declines, I think a lot of the decline is going to be at the high end of the market. There's still an awful lot of demand for entry-level properties and mid-price properties. And I think that'll keep those prices from going down. All in, though, Keith, I think it's fair to assume that we're going to see another decline in the volume of home sales this year. I'm estimating probably between about 4.3 and 4.4 million existing homes sold, and another 600,000 or so new homes. I would be more optimistic on the new home side, except I don't think the builders are going to bring enough to market to see those numbers go up very much more than that. And again, what's driving a lot of home sales across the board is those demographic tailwinds that we talked about earlier. Millennials are currently the biggest group of home buyers, and by far represent the highest number of first-time buyers. So they really are driving a lot of the trends. And we're starting to see the first wave of Gen Z buyers come into the market as well. So it's the youngins coming along, Keith. And the other 2 points to make, we talked about, one of them we didn't talk about, but I believe foreclosure activity will continue its slow climb back toward normal levels. Probably not back to 2019 levels overall until mid to late this year. But again, keep in mind, if you're an investor, the cycle's behaving very differently this time. If you're going to participate in the distressed market by buying properties, you're going to want to move upstream and look to work with distressed homeowners, or get to those auctions where you'll be competing with other investors, but don't wait for the repossessions. And investors are going to be a hugely important part of the housing market this year. Q4, they accounted for about 42% of all home purchases. And I believe as the overall volume of home sales goes down, that percentage of investor purchases might even tick up a little bit, because particularly for cash investors who are at a huge competitive advantage today, because the finance terms are 6 or 7% for an owner occupant, and even higher if you're financing your investor purchase.
There's been this long-running student loan repayment freeze. Once borrowers need to begin remaking payments on their student loans, do you see that having any effect here?
That's a really good question. I'm not sure I can answer it terribly well. It's interesting, though, that student loans are the only loan category right now that's not seeing a little bit of an increase in delinquencies. And that's, I believe, 100% because the payments aren't required at the moment. So I don't know when the Biden administration will lift the freeze on payments. I know they're still fighting, going back and forth, trying to have a little bit of a relief program in place for people with a certain amount of student loan debt. That's in the Supreme Court as we speak, whether determining whether that's legal or not. I don't know that a return to student loan payments necessarily increases delinquencies in other areas. But if you've now had 2 years where you haven't had to pay that loan, and you've gotten used to not paying it, do I
Right.
expect delinquency rates will be a little higher this time? Yeah, I do.
Yeah, yeah. Well, why don't you go ahead and wrap it all up for us, Rick? The current state of the overall United States housing market and where we're headed. Any last thoughts at all?
The housing market that I just described sounds a little bit unexciting. But all in, we're still going to sell about 5 million houses this year. And people still need a place to live. I think if a lot of those young buyers find themselves priced out of buying a house right now, they're going to look for a place to rent. And if they were looking to buy a house, they might be inclined to rent a house. So I think there's a lot of opportunities for investors. And I think it's important to keep all the numbers we talked about today, Keith, in context. Because even at 4.4 million existing home sales and 600,000 new home sales, we're not talking about the kind of bottom that we hit back from 2008 through 2011 when we were under 4 million home sales a year. So there's still lots of opportunities out there for people that do their homework, are ready to move when the situation presents itself, and become those local market experts and understand what's going on in their regions. Yeah,
right. Well, a bit of a boring housing market. As sometimes good investing really should be prudent and boring and stable and slow moving. So it was great to have the insights. Rick, if our audience wants to learn more about you and what you do and all your analysis and how you help with explaining markets to individuals and corporations, what's the best way for them to do that?
Well, they can certainly follow me on Twitter at Rick Sharga. I post stuff there a lot. You can also find me on LinkedIn, where I'm posting a lot of that similar activity. And then my company website is simply cjpatrick.com, and they can find out a little bit more about us there.
Rick, it's been valuable. Thanks so much for coming on to the show.
Thanks for the invitation. Hope we have a chance to do it again sometime.